Imagine waking up one morning, turning on the news, and hearing that the biggest banks in America are collapsing. People are losing their homes, the stock market is in a freefall, and the entire U.S. economy is hanging by a thread. It sounds like the plot of a Hollywood disaster movie, right? But this isn't fiction. This is exactly what happened in 2008, the year America almost went broke. And the craziest part? The warning signs started years earlier, when everything on the surface looked absolutely perfect. Let's rewind to the early 2000s. America felt unstoppable. The dot-com bust was in the rearview mirror, jobs were steady, credit was incredibly easy to get, and the housing market was on fire. It was the American dream on steroids. Everyone believed that owning a house was the safest, most surefire way to build wealth. And why wouldn't they? Prices were only going up. Banks were practically throwing money at people, handing out mortgages like free samples at a grocery store. They barely checked your income, your savings, or even your credit history. These were called subprime mortgages, and they were the first domino. You might be thinking, why would banks take on such a huge risk? Well, here's the secret. They weren't planning to keep those risky loans. Instead, they were selling them to Wall Street. Investment banks would buy up thousands of these individual mortgages, the good, the bad, and the downright terrible, and bundle them all together into complex financial products called mortgage-backed securities, or MBS. Think of it like a giant financial smoothie. You throw in a bunch of different ingredients, blend them all together, and sell it as one drink. These MBS were then sliced up into different pieces, called tranches, based on their level of risk. The safest slices got a AAA rating from credit agencies, the same rating as U.S. government bonds. This made them look like the safest investments in the world. Wall Street then sold these securities to investors all over the globe, pension funds, insurance companies, even other countries, promising a steady, reliable return. For a while, the system was a money-making machine for everyone involved. Homeowners got cheap loans, mortgage brokers made commissions on every loan they wrote, and Wall Street bankers made enormous bonuses packaging and selling these securities. The whole system was fueled by one simple belief: home prices would always go up. As prices climbed, people refinanced their homes, pulling out cash to pay for new cars, vacations, or home renovations. It felt like an endless party. Banks, brokers, and investors were all getting rich from fees and commissions. But beneath this glittering surface, a massive bubble was forming. The system was packed with risky borrowers who, in reality, couldn't afford the homes they were buying. Many of these people had what are called adjustable rate mortgages. These loans start with a very low, attractive teaser interest rate for the first few years. But after that initial period, the rate would adjust, often jumping dramatically higher. As long as housing prices kept rising, nobody cared. If you couldn't afford your new, higher payment, you could just sell your house for a big profit, pay off the loan, and walk away with cash in your pocket. Or you could refinance into another cheap loan. The party just kept going. But around 2006, the music started to slow down. After years of relentless climbing, home prices stalled. In some areas, they even began to fall. Suddenly, homeowners who had bought at the peak of the market found themselves underwater, meaning they owed more on their mortgage than their house was actually worth. Selling was no longer an option. And right on cue, those adjustable rate mortgages began to reset. Monthly payments doubled, sometimes even tripled, overnight. Families who were just barely getting by before were now facing impossible bills. They started missing payments. Missed payments turned into defaults, and defaults turned into foreclosures. Soon, entire streets were lined with for sale signs and empty homes. This flood of foreclosed properties onto the market pushed home prices down even further. It created a vicious downward spiral. Falling prices caused more foreclosures, and more foreclosures caused prices to fall even more. And that's when the real danger, the systemic risk, came roaring into view. Remember those mortgage-backed securities that Wall Street had sold to the world? The ones that were supposedly as safe as gold? They were all built on the promise that homeowners would keep making their monthly mortgage payments. When millions of homeowners stopped paying, the stream of cash that backed those investments dried up. All of a sudden, those safe assets were revealed to be filled with toxic, worthless debt. The big problem was that nobody knew exactly how toxic they were. These securities were so complex and interconnected that even the banks who created them couldn't figure out how much they were truly worth. Trust, the absolute bedrock of the entire financial system, evaporated. Banks stopped lending to each other because they were terrified that the bank they were lending to might be secretly insolvent. Credit markets, the plumbing of the global economy, began to freeze solid. What started as a problem in the U.S. housing market was now turning into a full-blown global financial crisis. By 2007, the early warning signs were impossible to ignore. Several major mortgage lenders had already gone bankrupt. Hedge funds that had bet heavily on housing were shutting down. The stock market was becoming increasingly volatile. Yet, incredibly, many people, including some of the most powerful figures in finance and government, still believed it was just a temporary correction. They thought the economy would bounce back just like it always did. But this time was different. The entire global financial system had become intricately connected to the U.S. housing market. It wasn't just a few bad loans, it was a systemic infection. As home prices continued their relentless fall, the pressure just kept building and building, like a ticking time bomb waiting to explode. And in 2008, it finally did, bringing the entire world economy to the brink of collapse. Understanding how this happened isn't just a history lesson. It's a crucial warning about how quickly things can go wrong when greed and complexity run wild. By 2008, a deep sense of panic was spreading like wildfire across Wall Street. Major financial institutions, the giants of the global economy, were sitting on mountains of what we now call toxic mortgage debt. The scariest part? Nobody knew just how bad the situation really was. Trust, the very foundation of the financial system, evaporated. Banks stopped trusting each other. Lending between these institutions, the lifeblood of the economy, slowed to a crawl, then nearly stopped altogether. Companies that relied on short-term loans to pay their bills and their employees suddenly found the well had run dry. They couldn't borrow money to keep their operations running. The entire system was freezing up like a complex machine grinding to a halt. Then, in September 2008, the breaking point arrived. Lehman Brothers, a 158-year-old investment bank, a name synonymous with Wall Street itself, filed for bankruptcy. This wasn't just any company going under, it was the largest bankruptcy in U.S. history. The news sent shockwaves that rippled through global markets in an instant. Stock prices crashed. Investors, big and small, panicked, selling off everything they could. Credit markets, which were already struggling, froze almost completely. It was a financial heart attack. Even giant, seemingly untouchable corporations struggled to borrow money just to make payroll. On the ground, for regular Americans, the fallout was devastating and immediate. The abstract numbers on Wall Street translated into real, human suffering. Millions of people lost their jobs. Home foreclosure signs started popping up on lawn after lawn as entire neighborhoods were filled with abandoned houses, sad monuments to shattered dreams. Retirement accounts, the nest eggs people had spent their lives building, lost huge portions of their value, evaporating into thin air. Families that once felt financially secure, who had played by the rules and done everything right, suddenly found themselves with nothing. The U.S. government watched this unfold and realized that if more big banks failed, it wouldn't just be a recession. The entire financial system could collapse, taking the global economy with it. So officials launched a massive, unprecedented $700 billion bailout program called the Troubled Asset Relief Program, or TARP. Using taxpayer money, the government started rescuing these struggling financial institutions, buying up the same toxic assets that had caused the crisis in the first place. The logic was simple. If the bank survived, the economy might survive too. It was financial triage on a national scale. But this decision made millions of Americans absolutely furious. While ordinary people were losing their homes, their jobs, and their life savings, the very banks that had driven the economy off a cliff through reckless behavior were being rescued with public money. To many, it felt like the system was fundamentally rigged. When regular people failed, they faced foreclosure or bankruptcy with little to no support. But when giant, powerful banks failed, they got bailed out. This created a deep and lasting sense of injustice that lingers to this day. The phrase, "too big to fail," entered our vocabulary, and with it, a profound distrust in our financial and political institutions. The damage from the crisis was immense and long-lasting. More than 8 million jobs were lost in the U.S. alone. Millions of families were forced out of their homes. The economic recovery was painfully slow, taking years to even begin to mend the wounds. The Great Recession, as it came to be known, left deep scars on a generation. But the story didn't end there. To get the economy back on its feet, the Federal Reserve and other central banks around the world took drastic measures. They started printing massive amounts of money and slashed interest rates to near zero. The goal was to make borrowing cheaper than ever, to encourage spending and investment, and to jolt the comatose economy back to life. This strategy, known as quantitative easing, did help markets recover. Stock prices started to climb again, and a sense of fragile stability returned. However, this solution created a new and perhaps even bigger problem. In a world of cheap money, debt exploded. Governments, corporations, and households all took on staggering amounts of new debt. It was like putting a Band-Aid on a bullet wound while ignoring the internal bleeding. Today, many economists are looking around and warning that the same troubling signs from before 2008 are appearing once again. The U.S. national debt is at record highs, an almost unimaginable number. Consumer debt, especially on credit cards, is soaring as people struggle with the rising cost of living. In many areas, housing prices have surged to levels that are disconnected from average incomes, creating another potential bubble. And now, to fight inflation, interest rates are rising again, making it much harder for all those borrowers, governments, companies, and individuals to keep up with their payments. The debate rages on. Some experts argue that the system is even more fragile than it was before 2008, burdened by this colossal mountain of debt. Others believe that new regulations put in place after the crisis, like the Dodd-Frank Act, have made the banks safer and more resilient. But one thing is absolutely certain. Our global economy is more interconnected and complex than ever before. A problem in one corner of the world can spread across the entire system with frightening speed. The 2008 financial crisis wasn't just a market crash, it was a profound lesson. A lesson about greed, about unregulated risk-taking, and about what happens when an entire system is built on an unstable foundation of bad debt and false promises. And the real multi-trillion-dollar question now is whether the world actually learned from that disaster. Or are we quietly, perhaps unknowingly, setting up the dominoes for the next one? Because if history has taught us anything, it's this. When the financial dominoes start falling, they fall fast. And no one, no matter how safe they feel, is completely immune to the consequences. Thanks for watching. If you found this interesting, don't forget to like and subscribe for more deep dives into the forces that shape our world.